So now we'll transition to our next highly anticipated session on the changes in corporate taxation. It's a pleasure to welcome Mr. Mukesh Butani. Hi, sir. So Mukesh is the founder and managing partner of BMR Legal Advocates, specializing in corporate international tax, transfer pricing, and indirect tax. With over 30 years of experience, he advises multinational and Indian conglomerates on FDI policies, business reorganization, cross-border tax structuring, and tax controversies. An expert in international tax policy, Mukesh has contributed to landmark judicial pronouncements and served as an expert witness on cross-border tax treaties and transfer pricing matters. His publication include Transfer Pricing, the Indian Landscape, 2 decades on, Taxpayer Rights, Deciphering the Indian Charter, and co-editing credits to the General Anti-Avoidance Rules, The Final Tax Frontier. Mukesh is recognized by national and international forums, including the IBGA list, Legal 500, and Chambers and Partners. A warm welcome to you, sir. The session is now yours.
Thank you very much, Ridhima and Taxman, for inviting me. May I request you to put on the slides because that will be more efficient. I have what, 25 minutes to speak
So yeah, you have got 30 minutes to speak. Please don't worry about that.
Okay, fine. So if you can put up the slides in the meantime, I will. Do you have the slides?
Okay. Yeah, so it is being shared.
Yeah. I will just keep on saying next slide. That would be more efficient. So what I intend covering, good afternoon, everyone. What I intend covering in the next half an hour or so, some of the key changes that have occurred by way of Finance Bill 2 2024 proposals and how they will translate and what kind of impact it will have on businesses and corporates. Please go ahead with the slides. The first issue that I wanted to cover is on buyback of shares. But next slide, please. On buyback of shares, I just wanted to take you briefly through the history because there have been many amendments that have occurred in the Companies Act. The Companies Act 1956 got transitioned into Companies Act 2013. Then we had a host of changes in the Income Tax Act. In fact, in the slides, I have not forgotten to capture one more change, which I discovered in the morning also, which was a 2016 that occurred in the Income Tax Act. And I'll talk very briefly about that. But to understand the change that is impacting the changes that have been carried out in the Finance Bill of 2024, it's important to understand all these changes that have occurred. Some of them are directly linked, some of them are not linked, but there is a consistent effort that has been put in by the government to stop buyback of shares, as an avenue for shareholders to earn tax-free income. That's the overarching public policy objective. And I support it by saying that the buyback provisions were introduced in the Companies Act by way of an amendment in 1999. This is the amendment to the 1956 Companies Act, wherein Section 46A was introduced. And by virtue of that section, the tax on income on buyback in the hands of the shareholders was proposed to be exempt. Thereafter, if you may recall, the dividend distribution tax regime was introduced in Finance Act of 2003. And as a result of that, the taxation of buyback of shares, which was more in the area of characterized as capital gains, did not get impacted. So there was an avenue for companies that was inbuilt into the Companies Act, into the Income Tax Act, and now with the 2003 DDT introduction, a mechanism by which you could take profits through the buyback route with appropriate tax planning. Clearly, in 2013, the loophole was plugged. The government, with an endeavor to curb tax avoidance, and this initially was applicable to unlisted companies, brought buyback on shares on par with dividend distribution tax, recognizing that buyback is nothing but shareholders are benefiting and there is DDT, so there should be BBT, BBT being buyback tax, exactly at the same limit. 20% was introduced, slightly at a higher rate, because the highest slab on dividend distribution tax really was 15%, and with surcharges it was coming to 18% or so. This tax was a tax in the hands of the company that was implementing the buyback. So shareholders were exempt. Specific provisions were there in the law to exempt the shareholders. In 2016, by the way, when this 2013 law came, the 2013 law specifically provided that buyback has under the Companies Act. Thereafter, many cases went to high courts where buybacks were being undertaken not under the buyback scheme of the Companies Act, Section 75, but under other provisions of the Companies Act. For example, reorganization, and hence the law was amended in 2016 again to say all forms of buyback, whether undertaken under the buyback provisions under the Companies Act or any other provisions of the Companies Act, or rather any act. As a result of which 2016 amendment came in. 2019 was a big amendment. In 2019, the buyback provisions, unlike the 2013 law, was extended from unlisted to listed companies. And then in 2020, when we saw abolition of dividend distribution tax, which was with a larger intent as to how should the dividend be taxed, did impact many forms of buyback, but buyback continued. Now, another important development that took place, which is neither Companies Act nor Income Tax Act, was in 2022, when SEBI released a consultation paper. And in the SEBI's consultation paper, while reviewing the buyback of securities regulations, which applies to listed companies, they proposed that the buyback burden of buyback tax under the Income Tax Act should move from the company into the hands of the shareholders. So what we are seeing now in 2024, and please move the slides, next slide please, is nothing but the shift from the individuals, from the company into individuals. Now, this was the reason. If you look at the recent trends of buyback, and now these are listed companies, this is publicly stated information, you see a steady increase, even in the COVID year, the quantum of buybacks was 36,000 crores for 55 companies. 21, it slowed down a little bit, not in terms of numbers of buyback, but quantums of buyback. Then it picked up again in the post-COVID recovery in 22, 23, and in 24 so far, we've also seen buyback. So if you look at these figures, what is the temptation? Temptation for any tax administration is, wow, this tax is now going out. There is buyback tax being paid because buyback tax applies to listed companies. Now let's look it in a wholesome manner, take into consideration what SEBI has to say, take into consideration the historical evolution of the law from an income tax point of view, and now we have the buyback tax. So next slide, please. Now, if you look at this slide essentially explains what the current scheme is, and that scheme applies until 30th of September 2024. How is a buyback tax, which I explained to you, the incidence at 20% plus surcharges, income is exempt in the hands of the shareholders, no deduction is allowed to the company, and buybacks before July 21 for listed companies were taxed as cost, the buyback minus the cost of acquisition on capital gains in the hands of the shareholders. And now the proposed amendments shifts the burden from the company to the shareholders, which means buyback tax as it stands repealed. A deeming fiction has been created that buyback will be treated on par with dividends. So 222, after 222E, 222F has been added to include buyback as a deemed dividend, which is income under Section 2. It will be taxed as income from other sources in the hands of the shareholder. There is prohibition that the shareholder will not be able to claim any deduction. Now, in order for the shareholder to compute or in order for the shareholder to take into consideration the value at which the shares were acquired, these are the shares that have been bought back, that value will be deemed as a capital loss, which means that you're taxing the entire consideration. You're not giving a deduction for the value you paid for those shares, which are getting cancelled as a result of the buyback, which would have happened had the income being taxed as a capital asset, but instead you're treating it as a capital loss. So this could be detrimental to some of the individual shareholders because they may not have capital gains. Of course, if they have capital gains, then they can set it off. The procedural part of the law is simple now. There is an obligation on the companies to withhold tax. So Section 194 now thrusts an obligation of withholding tax at the rate of 10% from residents, and then from non-residents, it will be 20% or the rate applicable under the treaties. So this is in a nutshell explaining what the buyback tax would mean. Now, the next slide, please. I've just drawn a very simple illustration. I'm not going to labor anything further on this, but this is just to be able to explain the last point I mentioned. How would the income be taxed in a buyback situation? This is a simple example where 100 shares are acquired at 40 rupees per share. So 4,000 is the cost. In 2025, assuming that the new provision triggers in, 20 of those 100 shares are bought back at a value of 60. So you bought 100 shares at 40, 20 shares are being sold at 60. The entire consideration of buyback, which is 20 shares at 60, is taxed as income from other sources. But what you paid for those 20 shares in 2020 at rupees 40, that 800 rupee is now your capital loss. In 2026, assuming you sold 50 shares out of the remaining 80 shares you had, and assuming you sold it at 70 per share, so you made capital gains on those shares. Those long-term capital gains are translated into 1,500 rupees. Now, this is the time you will be able to set off that. Of course, the set off of brought forward capital loss is not vis-a-vis only those shares. If you have any form of long-term capital gains from financial assets or non-financial assets, you can set off. In this example, we have taken that the SSC, that the individual SSC has no other capital gain in the future year after it has made income from the buyback. So what happens is that you're essentially deferring what would have been a cost of acquisition had the buyback being taxed as capital gain, and you're deferring it to the time you make the next long-term capital gain in the future. So that's really the larger message. Now, what does this mean? Next slide. By way of impact on various businesses. Now, this could be any form of impact on various businesses, but based on our experience, based on serving clients, we just plotted this chart. So barring the first bullet and the last bullet, which are negative consequences for taxpayers, you would see largely the 6 bullets in the middle are positive for the taxpayers. Now, I'll just take a few minutes to explain why what are the positives and negatives. As I had mentioned, the first bullet and the last bullet are negative for the taxpayers, and the 6 bullets in the middle are positive to the taxpayers. Now, clearly, and the first bullet is really from a foreign investor standpoint. Now, what happens is that when you compute income of a non-resident, there is income computation mechanism in India on the source-based taxation. And there is an income computation mechanism of the non-resident in his home country, assuming that's the country with which India has a double tax treaty. So India has now created a deeming fiction for this income arising out of buyback of shares to be characterized as dividend income, which is fine. But in substance, it is capital gain because there is an extinguishment of the shares which have been bought out. So in this situation, the non-resident, while offering that income for tax in his home country, assuming his home country taxes this income, would characterize it as capital gains. So this will create a dissonance on characterization. The same taxpayer in India as a source country, his income will be characterized as dividend income, and at the home country, it will be capital gains. Now, and when I say it is capital gains, I'm saying ordinarily it will be capital gains because it invested in a shares in India. Now those shares cease to exist as a result of buyback. So it is capital gain ordinarily. This dissonance of characterization could create challenges for claiming foreign tax credits because this withholding tax that the Indian company has implemented, it is obviously going to claim foreign tax credit in its home jurisdiction. So there are many treaties. That India has with countries where the domestic laws of those treaty partners put restrictions on foreign tax credits vis-a-vis the income. A classic example is France treaty. There are other examples of Dutch treaty. There are examples of Swiss treaty. Now, many of these treaty partners in their domestic law have very strict foreign tax credit rules, which says that you can claim foreign tax credit provided it is aligned with the interpretation under the treaty. So if the treaty classifies such buyback as income arising from transfer of a capital asset, that's where the friction occurs. That's just one example. We saw examples of that coming up in the context of how countries such as Switzerland, Netherlands, France have interpreted the most favored nation treatment clause, which, as you know, the taxpayers in India lost the battle in the Supreme Court. So that's just to be able to explain. The second one is the benefits under the new scheme, which I explained in the example earlier, would be high to a large investor who have capital gains as a recurring income. So, for example, if you look at the treasury income of large corporates, or if you look at how foreign portfolio investors are taxed, they constantly have income taxed under the head capital gains, but they also have losses under capital gains as well. So for them to be able to set off this deemed capital loss on buyback of shares is far more easier, far more flexible than, say, to an individual taxpayer whose example that I gave. The new regime is clearly beneficial for secondary acquisitions. I will just take a minute to explain. Rule 40 BP helps compute the cost of acquisitions in situations of buyback. I'm told that since the entire proceeds now are taxed as dividends, the erstwhile Rule 40 BB provided for deduction from the cost of acquisition of the original value. The original value was viewed as cost of acquisition for the purposes of computing the buyback tax. Now, it is the indexed cost of acquisition that would be considered. So that's the change. So Rule 40 BB gets amended to that extent to be able to take into consideration new buyback provision. The fourth is that the buyback now covers buybacks under Section 68 of the Companies Act, and which means that if there is redemption of preference shares, that redemption of preference shares will continue to be taxed as capital gains because of specific provisions under Section 55 of the Companies Act. So buybacks now would cover only buybacks under Section 68 of the Companies Act. there is clearly higher incidence of tax on all forms of taxpayers, depending on which slab rates they come in. So let's assume that the person whose shares are being bought back is an individual, and that individual has income, say, above 5 crore rupees, then the buyback of shares will be taxed at the highest slab rate, because the highest surcharge will apply to those individuals because his overall income is above 5 crores of rupees. We believe that this is also positive when it comes to cash flows for corporates, because the tax is now no longer being borne by the company, it is borne by the shareholders, and the corporates, while implementing the buyback scheme, is withholding taxes. So from a cash flow standpoint, the corporate doesn't have to execute the buyback and then pay the buyback tax of 20% over and above on that. Clearly, the last point is more got to do with obligations that will be thrust upon the company that is doing the buyback, because the company will have all forms of shareholders, residents, non-residents, trusts, companies, individuals with non-residents, and non-residents will have treaties, and hence it will have a withholding obligation. But I would feel that in a very scattered shareholder group, for the non-resident, the company would simply follow the process of withholding tax at the rate of 20%, and then leave it to the individual shareholders to be able to claim the treaty benefits. So that essentially is on buyback. I'm now going to move to the second segment, which is the abolition of angel tax. This is again a very reformative move. We are going to look at the implications as well. Next slide, please. The abolition of angel tax also has a history, and I just wanted to talk very briefly about that history as well. Have you moved the slides, please? Can you move the slide, please? Yes, next slide. Yeah. The abolition of, angel tax is also, kind of important. But before that, let's look into the history of the angel tax. The angel tax was first introduced in Finance Act 2012 by way of insertion of 5627B. 5627B was initially applicable to issuance of shares by Indian companies, and it was introduced for issuance to non-residents. At that point in time, the stated objective was that this is like an anti-avoidance provision, primarily to deal with situations of money laundering, and circulation of black money. This was the time when the 2G scam was at the peak of its debate, and there was a widespread, perception that many of the investments that came into Indian companies from outside India came at a super premium, and that shares of the company should be valued. This triggered off also introduction of the famous Rule 11 UA. Rule 11 UA essentially is the fair market value for valuation of shares. And the law simply provided that if there is a difference between the price at which investment is made with the fair market value, then the difference between the two would be deemed as income from other sources and taxable under 56(2), which is the charging provision. Obviously, there were many changes that occurred after 5627B. We had the government coming out with its famous, startup plan, and in the startup space, it was, the Department of Industrial Policy and Promotion that started giving accreditation to startups, but many startups did not find the recognition of DPIIT, as a result of which in 2019, there were many startup ventures which got themselves caught into the 5627B. This was choking up investments in the startup space, because in the startup space, essentially it's an idea, and it's that idea which mushrooms into entrepreneurial organization, so on and so forth. So obviously the shares are priced much higher, and no valuation methodology was really able to support it. The CBDT notification in 2019, carving out an exception for startups approved by the Department of Industrial Policy and Promotion, obviously did not cover the other startups. So since 2019, many of the startups that did not get that recognition found themselves, many assessments had taken place. In fact, we had cases where valuation reports were not accepted by the department. Department was thrusting an alternate valuation, so on and so forth. So despite a long list of carve-outs, that the angel tax, the rigors of 56 to 7B shall not apply to certain forms of businesses, whether they are by sovereign funds or by startups approved. There was still a whole lot of noise that was made by the industry, and that led the government to review that decision. But before it reviewed the decision in 2024, in 2023, the section was amended to cover all investments done by residents and non-residents. So they essentially, by deleting the word other than residents, they covered all forms of taxpayer, which created another fresh set of uproar by the entrepreneurs, because there were a lot of investments that many startups were mobilizing out of resident investors. So the originally stated objective of Finance Act 2012, that this is to address concerns relating to money laundering and round tripping and circulation of black money, no longer held true in 2023 when we extended that law to residents as well. Now, this was introduced in 2023 budget as a rationalization measure, and hence many assumptions under the erstwhile Rule 11 UA, which had the fair market value, were not fitting into the scheme of investments made by residents. And hence, after 2023 Finance Act, they prescribed 5 additional methodologies. So the fair market value methodology under Rule 11 UA was now added 5 other methodologies, like a comparable company multiple method, probability weighted expected return method. But the larger message was that it was choking the entrepreneurial spirit for new businesses to raise money. And rightly so, Finance Act 2024 repealed it. Now, as a result of this repeal, the impact is largely positive, but I wish they had addressed, more of these issues. So if you can go to the next slide, we will talk about the impact and consensus of where we stand. So clearly, there are many positives. The first 3 are really positives that we are talking about, because now there is no longer valuation required. Companies are free to issue shares at a premium. So there is complete discretion that has been given. If there is an investment that is made by the non-resident for which it will require valuation under the Foreign Exchange Management Act, it need not worry about aligning the valuation under erstwhile Rule 11 UA and the FEMA valuations. So the FEMA valuation will stand the test in case the investment is made by the non-resident. It's also convenient now to obtain capital for not just startups, for even companies that are not startups. We believe that the department's scrutiny under Section 68, particularly the explanation that got added to Section 68 by Finance Act 2022, will continue. will be over and above. So you may have taken out the angel tax provision, but scrutiny will continue under Section 68. So if you recall, Finance Act 2022 provided that Section 68, which creates a deeming fiction to add to the income, unexplained credits that are coming in. It added an explanation which says that this is not just about verifying the person who is the giving loan, but also the person who's taking the loan. And there was a deeming fiction that got created in Section 68, which says that if in the opinion of the assessing officer, he's not satisfied with the explanation given by either of the parties, then this could be added as an unexplained investment. So that provision continues. I would have thought that if there was some rationalization in Section 68, particularly the explanation that got added in 2022, it would have meant more positive for bringing in more money into the entrepreneurial ecosystem or into the funding ecosystem. Clearly, the GAR provisions will apply. Tax authorities will have right to look into a transaction, recharacterize a transaction. You can assume, you can say that 56.210 was a SAR, specific anti-avoidance provision, but there was a SAR and a GAR. Now the GAR is there, but the SAR has gone away. We also felt that there is another section which kind of invites an angel tax kind of an implication. It is 56.27B. Pardon my slide, it is not 50CA, it's 56.27B. We'll correct the slides over there, which could have been addressed along with the angel tax issue. So that seems to have got missed out. And on an overall basis, clearly, this is a big boost to the entrepreneurial ecosystem. So overall, very, very positive change. Next slide, please. Let's come to another important change on amendment to Section 37. Just to give you a background, explanation 1 and 3 of Section 37 disallows expenditure for any purpose which is an offense or it is prohibited by law in or outside India. I'm not going to go into the history of Section 37(1), but this section also settled down after many, many amendments. And there was one issue which was very litigative, which was that if there is a settlement of any proceedings, let's say, for instance, any of the regulatory authorities, pollution or capital markets regulator or anyone with whom you have a settlement, wherein there is no wrongdoing, you admit, and there is nothing that is proven by the regulator, and you are in that settlement, you make a payment. This was viewed as expenses incurred solely and exclusively for business purposes. It was clearly an expense that was not incurred for any offense or anything that is prohibited by law because you settled it. In those situations, this was claimed as a deduction. The two landmark decisions that stood out, confirming that these amounts are allowable under Section 37(1), despite the explanation 1 and explanation 3, which prohibited the expense being taken for anything which is in the nature of an offense or prohibition by law. One was the Prakash Cotton Mills case, where the Supreme Court took a view that expenses are allowed purely because it's compensatory in nature and not in penal in nature. So, it brought out a very fine distinction between expenses that could be penal in nature versus expenses that could be compensatory in nature. This was a very, very, broad ratio that the Supreme Court had laid down, and consequently, many of the tribunals and high courts then also, followed this decision. Thereafter, the Delhi High Court came out with another landmark decision where they came out with a fine distinction that where a payment is not in the nature of penalty for an offense, but it's it's a settlement of a lengthy trial. I mean, normally businesses get into settlement. Just to give you a common example, based on my experience as a board member in large listed companies, after the GST law came, many of the state governments came out with a scheme to settle the erstwhile state VAT disputes. Even before VAT law came in 2003, many states had sales taxes. So they came out with a scheme to settle sales tax dispute, and many large corporates went and settled these old disputes. So in relation to that, many judgments came following the ratio laid down by the Delhi High Court in the Desiccant Rotos case, where it says that if you settle a lengthy trial, then that is allowed as a deduction. Now, the not so good news is that these decisions stand overridden with the new law. Now, let's look at what the new law is. If you can flip the slide, please. The new law simply says that any expenditure incurred to settle proceedings initiated in relation to contravention under such law as may be notified. So we need to see what the notification is, because there is obviously going to be a CBDT issuing notification as a part of the official gazette. But before it issues notification, the concern is, what do you mean by saying settling proceedings? So the Delhi example that I just gave, that was in order to settle proceeding, not for a violation of law, but to avoid long-drawn litigation. So there is a long-drawn litigation that is taking place. And as a result of that, you settle proceedings. At least based on the first part of the explanation, it doesn't seem that that would get covered unless there is something notified by the central government. Now, we don't know what that notification would be. Would the notification cover statutes, or would the notification cover nuances within those statutes? Because to me, it seems the manner in which it has been worded, it seems that they would specifically cover a statute. So, for example, they may say that such law will include SEBI law of 1993, which means that any settlement that you have with SEBI under SEBI law would not get covered. Or there are many offenses under SEBI. They may say that offenses committed by listed company in relation to IPO, or which means that that would be notified. So if there are any violations that SEBI notices and you settle that with SEBI, then that would get covered. But similarly, if SEBI initiates proceedings for not reporting related party transactions, that may not get covered. So I think we need to wait and see how this thing pans out. At the bottom of this slide, I have mentioned that on one hand, the government has taken a lot of positive steps to decriminalize many of the provisions under statutory laws, SEBI, FEMA, and Companies Act being some of the examples. Now, decriminalization means that the government is saying that don't worry about about criminal proceedings, you can settle these proceedings. But the fact remains that many of these are in the nature of economic offenses. Many of these are veering on the side of proceedings for breach of law or violation of law. I think if you settle those proceedings, until and unless it is notified, it would get covered. It would not get covered under the exception. My last two issues that I wanted to cover was, next slide, please. One is on a gift by companies. This has been a topic of debate in many transactions. Just to give you explain the context to this provision. Under the extant law today, if you transfer a capital asset under a gift or a will or an irrevocable trust, it does not attract tax. Now, the debatable issue was that, can a corporate gift, will, or create an irrevocable trust, or can it be done by human beings? But leave that debate on the side under the common law. there was an exception that was provided that shares or debentures or warrants allotted under ESOP scheme by companies to its employees was carved out as an exception. And as a result of that, many taxpayers argue that if there is a transaction for gift of shares by a company, it will not be liable for capital gains tax. In other words, it will get covered under the extant law. This clearly came of a challenge by the tax authorities, because the tax authorities took a simple argument that if there is a gift, it has to be out of natural love and affection. That element was missing in a corporate gift, because the natural love and affection can be expressed only by human beings and not by companies. But whatever may be the debate, there was a lot of pronouncements that were made. These pronouncements, some of them were in favor of the taxpayer, some of them were against the taxpayer. So I've listed down all those cases, but the pronouncements that were made in the favor of the taxpayers, the views of the High Court, which is Bombay and Gujarat High Court, had been that when you transfer a share without consideration, it constituted a valid and genuine gift, and hence it fell in the exception. And the ones that were in favor of the revenue, it said that it cannot be automatically exempt, and you need to look into the intention of the taxpayer at the time of the transaction. And this has to be examined by the tax department to see whether all the conditions for a valid gift or a will or creation of a irrevocable trust was satisfied or not. There is also a decision of the advanced ruling authority which clearly says that you cannot have an intercorporate gift, and that's not eligible for an exemption. So this is the current framework of law. Now, what does this amendment mean? And what are the questions that are arising? If you can flip to the next slide. The amendment is very simple. Clause 3 of section 47 has been substituted, and it says any transfer of a capital asset by an individual or an HUF under a gift or a will or an irrevocable trust. Now, section 47 is an exception, which means that it is clearly identifying that it's only if it is by an individual or an HUF, it would be viewed as a gift or a will or an irrevocable trust. So this is 47.3 is a host of clauses that carve out the exception to basically, this is the definition of the term what will not constitute as a transfer, which means that anything which does not fall in this exception will be viewed as a transfer and hence liable. Now, this, in our view, puts an end to the entire controversy because the amendment speaks for itself. The amendment essentially takes away the argument that taxpayers were giving that in a corporate environment, you could have a natural love and affection. It overrides all the judgments of the Bombay High Court and the Gujarat High Court. Now, this would impact a whole lot of family settlements because in a classic family settlement, it was very common that as a part of the settlement, as a part of the succession planning, as a part of planning that could occur before the estates are getting transferred, that it was very common for families to be able to transfer many forms of assets, and those transfers which were not viewed as a transfer would get impacted. Now, the question is that, can you still take an argument that there is an individual that is transferring it, there is an HUF that is transferring it, and hence exception applies. But in a family structure, you may not have an individual or an HUF. You can very well have a property that is already in a trust. And if many of those trusts are getting reorganized or the impact of the beneficiaries are getting impacted, or the beneficiaries are, changing over a period of time because of death or succession, then how does it impact these? So I think there is a whole lot of changes that will be impacted. It could also impact past transactions as well, because family succession planning and others are put in place historically, and they move over a period of time. And it is also possible that interest of some of the family members who have been beneficiaries of the past family settlements could get impacted in the future as well, because this is effective from assessment year 24-25. Next slide, please. Now, we just wanted to discuss the withdrawal of the equalization levy. The withdrawal of equalization levy is simple, reformative on the face of it, but I just wanted to give you a background on the equalization levy. Equalization levy was introduced in the law in 2016. In 2020, it was expanded to cover transactions other than B2B transactions, and that's the time 2% levy was introduced. The impact is significant because India and US, as a part of 301 settlement, and this is a 301 settlement, and the US trade representative agreed to not expand the levy, not increase the tax, remain neutral up until the time India signs the multilateral convention. There is a host of changes that are likely to be expected. So you should expect more development in the area of digital taxation, with India being a part of the Pillar 2. We saw the finance minister's statement, revenue secretary's statement, expressing unstinted support to OECD two-pillar solution, but it also equally qualified that support by saying India has put out the objections for amount A and amount B under Pillar 1 as part of the process. So this is a development that you should closely watch. Right now, the 2% equalization levy has gone away, but I think there is more to come. Next slide, please. I'm not going to discuss the next slide on changes of tax rates, because they are fairly self-explanatory, and the implications are also given. What does this mean by way of tax rates? And there's some procedural changes that are impacting gift city operations. And hence, I would stop over here in the interest of time, because that's the only last slide I have. With that, Ridhima, over to you.
Thank you so much, Mukesh. I think this was extremely useful, and hearing it from you made it even more valuable. Thank you for covering the background and all the loopholes and details. Just since we already are short of time, just 2 minutes more. One query which has been coming up very regularly on this buyback thing is now that what if these shares which I am holding as stock in trade are bought back? What would be the impact?
If you're holding the shares as stock in trade, it's no longer going to be taxed as a capital asset. So I would say that the business income provisions will apply. So these changes will not impact those forms of transactions. So there is a CBDT circular which lays down broadly all the guidelines that in case you're holding a security, under what situation it would be classified as business income, under what situation it will be classified as capital gains. So what changes we discussed today apply only to income characterized as capital gains. If the income is characterized as business income, these changes have no impact. You need to bear in mind that that circular does not apply to foreign portfolio investors, because for foreign portfolio investors, there is a special provision that governs taxability, and there is a deeming fiction that has been created in the law which says foreign portfolio investors on sale of securities will always be deemed to have characterized as income as capital gains.
Right. Great. And one last thing on the dividend part, when we're taxing now that income as dividend, what would be the point of taxation? Will it be the announcing date, recording date, payment date received? What would be that?
I would imagine that all buybacks implemented on or after September 1 would get impacted. So, there is a provision laid down under the Companies Act on buyback. And as soon as the buyback, it will be deemed as a dividend on the date when the payment is made. So, because the law also is very clear, it says after subclause E and before the long line, the following subclause, any payment by a company, which means it will be the date of the payment that will be
Right.
as the date of declaration of dividend.
Right.
So
Right. Perfect.
you need to read this word payment along with 222F, which creates the dimming fiction for such buybacks being characterized as dividends.
Correct. Thank you. Thank you so much, Mukesh. It was a pleasure having you.
Thank you very much, Ridhima, and good luck with the rest of the conference.
Thanks a lot.